Hello, everybody. Welcome to week 5 of 2026. This is the Build Weekly Roundup. As always, you've got myself, Cameron Otsuka, and Matt Dines here to go through our top 3 topics for the week. A lot has been going on. First off, this morning we're recording on a Friday rather than our normal Thursday, but that worked out in our favor here. Kevin Warsh was just nominated by President Trump to lead the Fed, so we'll dive into that. There's been a lot going on in Japan land around JGBs, yen, and Matt's going to kind of explain what's going on with the Japanese life insurance industry and how that's affecting things like the carry trade that we've all been talking about. And then finally, we'll round out with a couple of quick hits, but the main one being around Bessent's call for economic growth with no inflation or less inflation than I think people expect. So it'll be interesting to see where we go with that. But to start us off, Matt, maybe can you walk us through what you're seeing today, specifically around Kevin Warsh, and I want you to kind of go through the history as well. I think you've got a couple of items you want to go through there as you go through each of the Fed
Yep.
nominees.
Yep. So, leaving our audience members, all the handful of them who tend to follow us over the course of the year or so that Cameron and I have been doing this, we like to bring in history, go to the source materials if we can, whenever we can, to look for footing, and then bring that background into like what we're living in the present moment. So the textbook on central banking, if you think of, if there is one, how to pick a central banker. If you've ever heard of the Bank of England governor Walter Bagehot, there's a column written under his pseudonym still in the Economist magazine. I haven't read it in years, just given the perspective. I've shifted to other primary sources. But in this book, Lombard Street, that describes the Bank of England, a fractional reserve monetary system, all of that, how it works. Um, there is a chapter 8 specifically, that goes into, and it's titled "The Governance of the Bank of England," and he spends a lot of time pigeonholing down on what makes a good governor for the executive of the central bank. And so that's, really what I see what we're going through here today in present times. And then I'll do a comparison with, some of the text he wrote on prior Fed chairs to see, what he may have thought about the banking governance decisions that we've made over the prior 40 years. All right. So to start, for background, from Badgett's perspective, identifying an individual for this job is one of the most important things for a country, a civilizational, group of people operating as a cohesive society. So I like this quote here, just to encircle the concept we're going after. Like, managing the cash reserve of the country is as precious deposit as any set of men can have the care of. So it tells you, like, this is one of the most important roles, like putting someone in. If you do this job right, um, things generally tend to work well. If you do it wrong, and there's like an infinite number of bad ways to make a poor selection here. Um, Generally, bad things can happen when you debauch the society's money, as the famous Keynes quote goes that we've talked about before. But in general, just first isolating, what are you looking for when you go after a central bank executive? Um, he goes after some, like, what are the wrong things to do, and I think what stands out is you don't want someone necessarily older, wealthier, strongman type of background. I'll get into that in a second. He actually recommends someone who skews younger. And I think, and the reason for that is they have a forward-looking time horizon of 20 years. Is kind of the advantage he's looking for. Someone who can think, what we would all view as medium or long term. So they're not so focused on, the present time, or shortened lifespans in front of them, protecting existing assets or power structures. They have some longevity in front of them. This is where I think Kevin Warsh's background comes in. He was one of the youngest Fed Board of Governors ever, as far as my knowledge goes, when he was nominated in 2006 to serve as a FOMC governor under the George W. Bush second administration, and he lasted until 2011. I think there were some, maybe some political differences or philosophical difference between his views and the way he saw the board and the Fed moving in the post GFC environment. And I think if there's one thing you can take away here, this kind of represents a shift, if you think about it, from the way that the Fed has operated over, not just the 2010s and what we saw in terms of QE, um, public money expansion, all of that. Um, it goes back even further, in my opinion, to the 1980s and decisions that were made and how we structured and made governance decisions as far as the executive at the Federal Reserve for the United States. So we'll get into that in a second. But what I think has happened, just to throw this out there, this seems like Kevin Warsh was probably the optimal pick all along. Like he had everything you'd look for, and I'll go into that from the Bagehot checklist. He also had the experience at the Fed Board of Governors as well for 5 years. He's on the younger end, which is a good thing from the Walter Bagehot perspective. Um, and I think the headlines we've seen now that we have this news Friday morning, the push of Kevin Hassett for Fed chair, since basically May, June last year when those kind of rumors started to float, and basically the way I view that is that was just some chum thrown in the water to throw the scent off of basically a year of, which would just be called like beating up Kevin Warsh as your intended nominee all along, or maybe a short list, um, as a kind of a distraction tactic. So now that he's proposed for Fed chair, he has to go through Senate confirmation and approval. Um, that process can take place in a shortened time frame, weeks, maybe a month or two at most, but we have a hard deadline of May to fill this seat. So the political infighting around this highly important seat, it gets compressed, and basically you shielded Kevin Warsh from all of that politicization, the hyperpolarization, basically the challenge between the legacy incumbents who we described last week, talking about Davos in the aftermath, representing kind of the globalist post World War II order. And on the flip side of that, you've got kind of the American sovereigntist movement, which is paired up by other sovereigntist movements popping up, across countries around the globe, by the week now, it seems. Basically, Kevin Hassett served his job, in my opinion, as the decoy very well. So
Yeah, I thought that.
props to Kevin Hassett. He did his job. But if you look at the checklist, he doesn't fill the boxes of what you're looking for out of the ideal candidate. So Cameron, go ahead and I'll talk about that short
I
list.
was just gonna say from my perspective, right, I thought the worst nomination came out of complete left field for me. I was not aware he was even in the running, right? So I
Oh, he was on, yeah. If you follow Polymarket, he went down as low as 8% or like single digits, and then he shot back up. But yeah, I think the key here is from a tactical standpoint that the Trump definitely got the market, the media, everybody involved to bite on the bait that was Kevin Hassett. So
absolutely.
good job. So the factors you're looking for out of the executive to run the central bank and Walter Bagehot's perspective, number one, top talent of their generational cohort when it comes to banking. This is Kevin Warsh. Like he's got a background, I want to say undergrad Stanford, um, JD from Harvard, I believe, was on the board of governors by like his late 30s, served 5 years. That 2011 was 14 years ago. So this is a guy probably in his 50s now, if I'm just guessing age, mid 50s. That's definitely a situation where you have 10 to 20 years of horizon in front of you. Um, you're looking for age, and then health is the other thing. We don't have HIPAA records or anything like that, but you're assuming health checks out. That's great. You want someone no longer actively involved in the banking industry, but they come from it or they have the relationships so that you don't get the conflict of interest or managing to your own book of business, stuff like that. So you're not throwing out favors. You're really representing uh, the system from the framework itself, working for the interest of the system, everybody's mutual benefit, as far as focusing on choosing winners and losers, as someone weaker in this role would be pressured to do. Um, you want experience and a network with merchants and industry. So you're kind of like understanding the core business, who are the clients to lend to, what's going on in the economy, but you're more of a jack of all trades, master of none is what you really want to be. Um, and then Badgett calls this out. You want someone with lots of leisure time, like a surplus of personal capital, and deployed with their capital into basically assets that give them a low risk of ruin. They're not into speculations. They're not, making bets. You've never seen, as far as I know, Kevin Warsh come out as far as like you see with Bill Ackman coming out as taking activist plays. To my knowledge, over the last 10, 15 years, I haven't seen a headline where Kevin Warsh is throwing private capital into a political venture or, involved in some deal. So from what you'd look for to Walter Bagehot as your guide, this looks like a good pick to me. Now, I'm going to go through that same chapter as I'm reading this. I reread it this morning. I'm going to go over some things that Bagehot warned about that are, from his perspective, interpreted in a modern day. You would say this is not a good way to go as far as the the people put in roles, in governance roles, to basically manage your civilization's cash reserve. And let's just go to this one. Alan Greenspan, widely known as, like, people look up to him as like the goat of the Fed, central banking. He served as chairman for about 20 years under, let's see, Reagan, George Bush one, Bill Clinton, George Bush two. So four presidents, I believe, if I'm running that correctly. So he spanned Republicans, Democrats, everybody, the whole uniparty in Washington D.C. This was their guy. But if you really think about it, I want to go through what Bagehot wrote. When you put, what do you call it, just like a power figure in charge who runs this thing for the long term, the risks that arise. So I'll go to this quote. A permanent governor of the Bank of England would be one of the greatest men in England. He would be a little monarch in the city. He would be far greater than the Lord Mayor. He would be the personal embodiment of the bank. He would be constantly clothed with an almost indefinite prestige. Everybody in business would bow down before him and try to stand well with him, for he might, in a panic, be able to save almost anyone he liked and to ruin almost anyone he liked. And it goes on from that. Like, basically, you had to curry to the favor of this great man. Um, he's basically the be all and end all of money. We could go through the Time magazine cover. I think from the pull that up, Cameron. We don't have this fast of chops put it up, but now that I'm thinking of this, there was a Time magazine cover from like the Asian financial crisis of the late '90s. 1998 is when it really hit its head. But you got, I think this was the era where we got that Time magazine cover where it says like Masters of the Universe, stuff like that. It's basically just worship of like Alan Greenspan, central bankers. Like, these are the magical emperors who are the ones who are going to save us from any monetary crisis. That's really the way this operated. Bagehot warned against this, but I think in hindsight, for 20 years, this was a mission critical problem of somewhere where, in my opinion, the United States, from a domestic monetary policy standpoint, veered like tremendously off course. And now we're still living with the repercussions of cleaning this up as of today. all of these things Bagehot says to watch out for, really they come true. So I think it as the historical record kind of gets updated, we think about it. I think we'll look back on this with clearer eyes as time gives more opportunity to reflect on what we just went through, and at least like my lifetime to date, roughly 40 years in. All right, next one, another quote. I'll bring this up for Ben Bernanke, who served as chair after Alan Greenspan, 2006 to 2014. Notably, I've got him right behind the Brookings Institution. You'll see, for the last few years, Ben Bernanke taking these roles with think tanks in Washington, D.C., going after their prestige. I've seen him be I've seen him on as a advisor to Citadel Securities, for example. They'll have him on to talk with closed door presentations about what's going on in the financial system. I think it goes case in point. And now let's go to another Walter Bagehot quote. I'm throwing some punches here today, so these might come back to me as challenges, but I think the historical record will back me up here. So Walter Bagehot gives a warning about putting an executive in charge to run governance of your central bank. Saying a large bank is exactly the place where a vain and shallow person in authority, if he be a man of gravity and method, as such men often are, may do infinite evil in no long time and before he is detected. So what he gets at here, this belief, this savior complex, I've been studying this my whole life. I'm the man for this job. We need to do these drastic measures, X, Y, and Z. Like basically a hero complex, which is very close or adjacent to ego and vanity and the desire to fit in, I think, with basically elitism as it operates out of Washington, D.C. and New York City as power centers. I think those risks are the exact thing that Bagehot calls out. So with these measures we've taken in the post-2008 GFC to date, massive QE, currency debasement, I mean, everything we've seen from basically the um, starting with the Alan Greenspan Fed, but then really um, stepped up to crisis level policies with Bernanke and Janet Yellen's term as the executive at the head of the central bank. I believe what we saw with Jerome Powell was an approach to unwind those policies and shift us back on course. And my hope is that this, broader movement we're looking at to basically revalue sovereignty, protect and conserve your nation state's cash reserve. I'm hopeful that this Kevin Warsh pick is a pivot to a better direction, which, if you go to Washington, D.C., anybody involved in central banking, banking in general, policy, they'll they'll hold up Walter Bagehot's Lombard Street as the Bible. And what I'm asking for here is let's all read it. Let's go back to basics here. So I think that's where we're at. Cameron, I think unless you have other comments here, that ties off our commentary on the Fed's Kevin Warsh pick for the new executive.
Yep. Yep. I think, just to round that out, I mean, what I remember, so when I was coming out of college, Ben Bernanke was actually releasing his book. And I've got a signed copy because at the time, right, it was very much in vogue to say, "Oh, hey, the big deal. He used to be the Fed chairman. Let's go and hear this guy speak." But I think looking back upon it, you start to realize, you start to see some of these things that you're calling out with, I guess maybe not just Ben, but also a few other folks in high level positions. All right, so let's move ahead then to the next slide here. We've got the Indonesian stock market. It actually halted in twice. So the first FT article on the left hand side is on the 28th, a couple days back. And then the one on the right is literally the very next day. Goldman Sachs adds to some of the warnings that MSCI voiced, and we saw another exchange halt. So Matt, kind of you mentioned to me you're seeing signs of something going on here. So I'm curious, how does this tie into the broader kind of Asian markets and exchanges?
Yep. So if we're going to touch this one very quickly, Indonesia, not on everybody's radar, but I want to call it out as an INR, or sorry, INW, indication and warning of basically a light flashing on the dashboard. Hey, let's check liquidity conditions here. This was our a story here we had in the block to cover before the big news of Kevin Warsh today. So very quickly, just to go through what's happening. Yeah, Cameron mentions it. I think it was two occasions trading was halted on the Indonesian stock exchange. Why does anybody care about the Indonesian stock exchange? In terms of Southeast Asia, equity markets, um, and I'm not including the basically the more eastern countries, you'd say like Japan, South Korea, Taiwan, China, which tend to have a little bit more tech exposure. So we even American investors would pay attention to those equity markets a little bit more. These would be more like the Southeast Asian economies. There's not so much, not as much going on in terms of tech, semiconductors, et cetera. So they're not really like taking a front and center role over like as they are in Western media, talking about GPUs, supply chains, Taiwan semis, Samsung, et cetera. But Indonesia is the largest stock market by capitalization across, say, Vietnam, Philippines, Malaysia, Thailand, and Singapore. Singapore is, as a global financial center, very important. But this does show up in terms of almost $1 trillion of market cap. Now I know in terms of market caps, $1 trillion is at this point, you're not a Mag 7 anymore. You're below the cut for one of the largest companies in the U.S. S&P 500 index. Maybe you're somewhere in the 10 to 50 range is what $1 trillion would rank you at today. But what this represents in terms of liquidity, right? So I don't want to spend too much time here, but 1998, the Southeast Asian financial crisis, which I actually talked about a little bit in the Fed just discussion, like you had some problems that really amounted to cross-border linkages and lending. There was a buildup as Southeast Asian or growth was very rapid in these economies. And like basically you saw a lot of dollar-based borrowing to fund this economic growth, which ultimately like collapsed as the tide went out. You had a lot of bad credit problems. There was a true like currency level crisis, which means think about a financial crisis when it hits your bank. That's one thing, or your commercial banking sector, your financial sector. That's one thing. Kind of what the U.S. looked like in 2008. But once it starts to hit your central bank, your currency, and your sovereign government, like that's a next level kind of acuteness like stage of that same problem. So if you look at Indonesia in particular, they've implemented some moves, basically swinging the pendulum from one end where they were at in 1998 to the complete opposite in where we stand today in 2026, like looking at what banks are allowed to do in terms of um, lending, right? And within Indonesia, they've really shifted from relying on foreign capital inflows to support their targeted economic growth to focusing on the domestic market. But they've also done things like implemented like legal measures where it makes like bankers legally like liable and like criminally punishable for bad credit lending. So what you're actually seeing in Indonesia is kind of it's a monetary system, it's a liquidity tightness, but it's generated by policies that are on kind of the other end of the spectrum than we've seen with like kind of monetary profligacy we've seen out of say the United States or something like that, like QE, that type of central banking, the Japanese model. But One of the things I'm looking for, right? If we're looking for like a tightening in global liquidity conditions, at some point you should see this show up in financial sectors, insurance, somewhere. And so far, it's been hard to see. Bank stocks, across the world, they performed well since I'd say since 2023, the U.S. mini banking regional crisis, which we'll touch on a little bit in a second. Um, but what you're looking for, signs of stress, the Indonesian banks are definitely showing that at this time. It's got their own unique circumstances. It's primarily domestic, but the halting of trading in the equity market says that's a flashing red light. There's a shortage of liquidity in one market. This is a country that's tried to self-contain um, its own financial system to avoid those cross-border complications that can like burgeon into something like we saw in 1998. But now we're seeing similar on the kind of the mirror image, if you will. So I would say, and the banks in Indonesia, the largest would be call it the Bank of Central Asia. Like I would think of Central Asia being somewhere in the middle of the giant landmass, in Kazakhstan or something like that. That's not actually where the Bank of Central Asia is. It's in Indonesia, believe it or not. But you've seen stocks and their financial sector down 57% at this point in terms of drawdown in local currency terms. Um, so that just tells you that's a big pullback in the financial sector. It's a symptom, not necessarily the cause of counterparty risk and escalating contagion. But I do think it's pointing us in the direction, hey, we should be looking for signs somewhere else. If there is stress involved, what could actually be the like providing the knitting to patch some of these different exposures where a pop-up could materialize further. And that's where I think it take us into what we saw in the Japanese bond market. This was, I think, January 20th. We had two back-to-back days where the long end of the JGB, the 40-year maturity, rose by about 40 basis points in 2 days. This is something at Davos. Scott Bessent commented, hey, this is the Six Sigma standard deviation event. So I think it's first important to identify what in the world is going on, because most commentary, if you see it in your news feed, your social media followings, et cetera, they haven't talked about anything in depth as far as what is the actual problem here. They just talk about, hey, Japan's coming off 40 years of QE. This thing's going to rupture. This thing's going to burst. Get out, flee for the hills. So I'm going to go over a little bit of what's actually happening so we can hopefully get our bearings and then understand where we are, understand your environment so that we can position ourselves with a framework to help us in the next coming weeks, maybe months, as this material or this situation may materialize into something bigger than what we've already seen, which I'll say so far in 2026, like we've seen nothing yet, despite all the headlines we see, the volatility. As far as financial markets are concerned, we haven't even seen the fireworks go off, in my opinion. All right, so just set the backdrop. Cameron, you pulled this article going back to November. Japan announces 135 billion stimulus and bid to support economy and consumers. What you're looking at here in Japan, after 40 years, you've got inflation rising, right? And it's elevated. And it's at the point where the Japanese sovereign debt market, which were basically trapped at zero, even negative interest rates out to, let's say, 10-year maturities, like just craziness. Because consumer prices are rising, people are stressed, their money isn't keeping up with the debasement. So yields have to rise in order for the money to basically stay on the rails. So it comes down from a Japanese internal perspective. If you let this keep going, money dies. Your civilization goes into basically chaos as internal political economy and order fragment. A new order has to emerge. That's a volatile, violent process. Nobody wants that. So from the Japanese standpoint, yes, there is something new coming. There is going to be a shift in the monetary system, both in Japan, United States, everywhere. I think that's clear. From Japan's internal standpoint, you want to let this happen in such a way that you can maintain internal stability to the greatest degree possible. And that's where you get into this situation. I mean, you can see this in the U.S. as well. You see threats from within, threats from without, all of that. There's when we're in these moments, it can be a free for all. But Japan so far, the Takahashi government, they are trying to do this, in my opinion, in such a way that preserves societal and cultural stability. All right, and that's where the 135 billion in stimulus support that comes in. It also explains why the LDP with the new Japan Innovation Party as junior partner with this new coalition, they've called new snap elections on February 8th, basically to consolidate political power internally. In my opinion, you do this to have the votes, have the governance power and authority to address a potential flare up as, say, maybe a crisis emerges, if one emerges. All right. So, talked about the snap election. What you're looking at in Japan, you've got volatility, not just the JGB sovereign debt mark, but also dollar yen. So things are operating like on a knife's edge right now. It's touch and go, to make a saying. So what's the root cause here? And this isn't just coming up, the meme of the old guy with gray hair holding a coffee. He's like, I'm an expert on repo markets today, or I'm an expert on the current thing. What's actually going on under the hood, like if you talk to the expert in gray hair, within the next few weeks, I believe it will trickle in. The core of the problem right now is actually forced selling from Japanese life insurers. So what happened over the Nikkei collapse in the early 90s? Basically, you see a decline in interest rates as growth stalls out, credit creation dries up, bad credit from the speculative real estate boom in Japan have to be digested and dealt with. Remember the famous anecdote, right? If you looked at the land around the Japanese Imperial Gardens in Tokyo, it added up to basically the entirety market value of the whole of the state of California itself, right? So it was massive speculative bubble. We had to deal with the unwind, right? So interest rates collapse. At the same time, you've also got the demographic trend where population growth stalled out, birth rates declined below replacement levels, and you've got a gradual aging taking place in the demographic curves for Japanese society. So what people did in that environment, you go to the bank deposit. If you want to park your savings there, they'll pay you zero. If you want to buy a Japanese government bond, you're going to earn negative. The product that filled the space or filled the need for those aging kind of retirement savers were life insurers with annuity and whole life products. So they were able to promise like 1% to 2% yields, which if you're a Japanese, citizen at those times, you need retirement, you need income, you need savings. Stock market was in a bear. Like it was like, if you go back and look at the Nikkei, like collapse, and it's just now in the last couple of years returned to an all-time high. This is like people surviving in the U.S. the Great Depression in the 1930s, 1940s. They didn't come out of it and from a balance sheet perspective come out whole until like 1970, 1980. Like it's crazy how long it took. But like when you look at the numbers in nominal and real terms, like it eats up half your life. But what happened is instead of like flowing your savings into the banking system or sovereign debt, the life insurers built products to serve them. So you pay 1% to 2%. Then you look at how did they actually do that? Well, they were buying things like utilizing other currencies, going out and buying, say other debt, U.S. dollar denominated, could be, or euro, et cetera, anything higher yielding. And that's what you would do to support your 1% to 2% payout rates to your future annuity tense, I think would be the term, right? So what's going on now as yields come up, as the price levels, CPI in Japan has been riding hot above target for multiple years now, basically like 3, 4 years, et cetera. Government bond yields have had to come up in response. What that is saying in like practical effect is that the real goods and services economy, as well as the supply chain infrastructure that's built out for international trade, that was the post-war kind of economic order, and then also the financial system, the global dollar system, and then number two on that list would be the Japanese yen as a funding currency to support borrowing and capital for funding schemes that required
This is
it.
the carry trade people talk about.
Yeah, those two things are going away. So the dollar, we've seen the teardown in the offshore dollar financing scheme, starting with the launch of SOFR in 2018. Then we get into hiking rates in 2022. You get things like the deprecation of LIBOR starting, I think it was last year was the final, but it's over. No more publishing LIBOR. So the US dollars offshore capital pool that financed the global credit bubble, that made the whole post-war economy and financial system possible, that's gone. So number one source is off the board. Number two would be the Japanese yen. That's your secondary pool, right? So that's going away and we're in process. So if you make the analogy to where Japan is right now on its own journey, I think we're at that point. Like if you look back at the curve of the Japanese 10-year, or you can look at the 40-year, you see the chart. Yields bottomed in 2020. They don't go like sell off like, all right, the bears have won here. Rates are going higher. That doesn't like become markedly clear until you see the transition away from Kuroda as their Fed chair to the new Ueda kind of Bank of Japan governance era. At that point, you start to see this repricing of Japanese government debt taking place, right? And so basically, yeah, 1 to 2 years in, and that process allowing to play out. What you're trying to do here is let the reset happen. There's going to be volatility that shows up, but you don't want to make it so volatile that like, hey, something collapses. Oops, that's going to topple this process, makes our problem worse, etc. So the analogy I make, I think, to where Japan is right now with the life insurers looks a lot like where the U.S. was with regional banks, some crypto-friendly banks, and it ultimately spilled over to a G-SIB in Switzerland, which was the target. Someone wanted a piece of that with Credit Suisse, and there were strategic and geopolitical moves there made as well in terms of my understanding of what actually went on. But if you're looking at Japan's situation, I think to make an analogy, what the dollar went through domestically or due to like domestic kind of volatility in its own financial system in March 2023. I think we're looking at something along those lines with Japan and its own kind of a little slice of its own, domestic financial system with life insurers. This could also spill over. I'm hearing chatter about like some regional banks, like those who primarily serve populations not in the major metros like Tokyo, Osaka, Kyoto, stuff like that. They're focused on the smaller towns, which are in general kind of losing the young population. They're full of kind of aging retirees who are naturally either going to kind of die out or age out of the annuity policies, or they're naturally surrendering those policies, giving inheriting the proceeds if they don't no longer need them to their children, who tend to live in the larger metropolises, and those deposits tend to flow into your large Japanese banks. So this isn't like a 2008 type of environment in the U.S. when it was your G-SIBs who were under threat. it looks more like the March 2023 U.S. mini banking crisis, in my opinion. So in net here, I kind of explained this, but let's say you're a retiree, you bought an annuity from a Japanese life insurer back in 2004. It's going to pay you 1 or 2%, but now you can go out. You can if you um, take a surrender charge, you can recall your money from that life insurance. It'll be a penalty, something like 5, 10%. It'll cost you to get your savings back, but you can call it, and then you take that money, you park it either in a bank deposit at a large Japanese financial like Mizuho, et cetera. Um, you'll earn higher yield than that 1 to 2% now, as even short-term rates in Japan, like I think they're at this point up to 75 bips. Next hike will take it to 1%. They're going to keep hiking, right? We're nowhere close to the annualized run rate on, price level, inflation in the real economy. So this problem will continue to not just exist, but it'll actually get worse as rates have to rise further. Um, and then you could also, if you're a Japanese, saver, there's also the kind of the trend like we saw in the United States with Treasury Direct, where households can go out now buy treasuries directly, as opposed to, hey, you can still buy them from a broker dealer. Not everybody has a stock account or a brokerage account in the U.S., although that's pretty popular. And the same way in the Japanese economy, there's also a trend. You can go buy a Japanese government bond. So if a saver now sees, oh my gosh, 3, 4% on a Japanese government bond, they're incentivized to go do it, right? Like you can literally like take a
Yeah.
10% haircut, but you're literally going to get, double, triple your annual income. Um, and so even though you're still in a duration headwind environment, as rates are cyclically still on their way up in Japan, people will still do it. There's still a huge
The
incentive to
comparative
do
to
it.
what
So
they
that's
have.
where you
Yeah.
get into yeah. So that's where you get into the effect for every 100 bips of increase on the Japanese government bond yield curve. I saw an insurance, publication that said the surrender rate for these life insurers goes up by 25 basis points. So what this is actually doing, like the way it materializes, if you're an insurer, what you want to do is what's called ALM, asset liability matching. You want your assets over here, your duration, to match the duration of your liabilities during the secular. It's a hard thing to do. Like it's hands-on work. You don't just set it and forget it. This involves trading, interacting with capital markets, hedging, all of the above. It takes real professionals to do this. In a bond bull market, when rates are headed on their way down, it's not a hard thing to do, right? And what you saw from the life insurance industry going into this was that the duration mismatch between assets and liabilities was at like 4 to 5, which basically meant as rates were declining, the value of the assets would increase faster than the value of the liabilities. So on net, as an equity holder in a life insurer, you like the great bond bull market. Now, however, with the rising rate environment, that positive 4 to 5 on the duration mismatch has flipped to negative 1.5, which means actually as interest rates go up, your duration mismatch gets worse. So what's happening is like, yeah, you're slowly eating into the equity capital for the ultimate owners of these life insurance entities. And that's where you start seeing things like January 20th, those 2 days where we saw 40 bips of sell off, the Six Sigma move in the Japanese debt markets that Scott Bessent talked about at Davos. What that is that's forced selling. And research from Goldman Sachs says they point to life insurers who they're forced sellers of their long-term bonds that they accumulated a stockpile of in the 40-year, or call it a 30-year secular bond bull market in Japan, starting with the collapse of the Nikkei. But yeah, that's where we find ourselves today. So if you look for the stories, you want to see what's around the corner. This is actually fascinating when you want to think about the linkages here. So we've seen in private credit, right, in the last 6 months, that bullish, 2022, 2023, 2024, the golden age of private credit where everybody was talking about, right? The tenor has definitely changed, right? And the underlying backdrop of the private credit market. You've got, you go look at Apollo, KKR. I know Apollo, I've been following this chart, peaked in December 2024. It's been in a retracement since. So it looks like the bid, at least as far as Mr. Market, has pulled back. They're preparing for, something. There's some sort of event that'll hopefully put in a bottom. Um, but what you're looking at here, if you dive into the Japanese life insurers trade, a lot of the reinsurance risk that they pass on, the largest holders tend to be tied to the US private credit industry. So you'll see Apollo Athene mentioned here. You'll see KKR heavily. You can, follow these individual names, but this is connecting the US to what we're seeing in Japan as they go through that repricing of their own sovereign debt markets. But my point here, I'll get across the connections. We're looking at cross-border capital here. So you're seeing the U.S. private credit issuers combined with the Japan life insurers, and then you've got their offshore reinsurance arm. So Athene would be, tied to Apollo. They've officially merged here in the last few years, but basically their business model. Athene is also an annuity issuer. Same thing or similar to what we saw with annuity issuers in Japan. But this whole triple concoction, watch in the weeks and months ahead. If this does continue to materialize, I would expect you to start hearing more and more in the headlines about the Bermuda Triangle. Is how this story will probably be referred to.
Yeah.
Now, how do you address this from a policy standpoint? This isn't 2008, in my opinion. Japanese civilization isn't going to collapse because of 1 to 2% annuities. 2023 in the US, the Powell playbook, what we did, we launched the BTFP that allowed banks in the US or the regional banks to, as their own bond holdings were selling off, interest rate volatility was showing up in markets. What we did was we created a facility that would allow the banks so that instead of having to force sell their their loans, bonds, credit assets into a volatile market, ultimately exacerbating the problem, making things worse. What he did was, or what Powell did was launch the BTFP, which basically allowed them to post what the system would view as good assets. Now that's arguable, right? When we talked about the history of central banking, did we actually create good assets? That's up for debate. But for this exercise, let's just assume the government bonds and then associated agency debt relate like government approved borrowing under other programs, authorities, agencies, et cetera. Those loans, bonds, et cetera, were allowed to be posted to the Fed as good collateral without taking a haircut on the loans at, this is where he got it wrong when we go to Bagehot's quote, lend freely at a high penalty rate, right, in times of crisis. Well, we lent at a very favorable rate. It was the 1-year swap rate based on overnight index swaps plus 10 basis points. That allowed the banking system time to basically borrow, access dollars, pay their liabilities, et cetera, and not have to become forced sellers in the market. It worked, right? By and large, that policy's like it was a success, and it also didn't make the U.S. credit bubble problem any worse, in my opinion, than it had already built up over 40 years from Greenspan era to Bernanke, Yellen, et cetera, as we talked about in the first segment with the new Fed chair news today. But yeah, I think a Japanese program will have to look something similar. Bank of Japan is going to have to create something for both its regional banks. They call them shinkin banks, which are basically, think of them as credit unions in the U.S. is a good analogy. So they're not necessarily banks. They don't, post reserves at the central bank, et cetera. And then also the insurance segment. So it'll probably, the ideal will look something like the BTFP, but maybe even a little more longer term duration than just 1 year, maybe two, three, something like that. Um, and then because of the linkages between the Japanese, non-bank financials in terms of funding and reinsurance risk, it spreads over into the U.S. with private credit, which the U.S. commercial banks are heavy lenders into the private credit industry. They're levered 2 to 1 as opposed to a bank, which is 9 or 10 to 1 typically. So it's less of a credit concern, but still, these
Still levered.
cross-border decisions that have been made over into Japan. Like now we're on the way down the mountain. We walked up the mountain, the hard part. If you're ever in mountain climbing, um, up takes a long time, but down is slow and fast. Or no, sorry. Down is like fast and takes a lot of energy. It's harder than you think, right? Slow and fast. It doesn't make any sense. Like ignore that. But the way the descent down the mountain is what tends to be fast. And takes a lot more energy than you would think. So for that, yeah, and then also the other leg of the insurance triangle is the offshore reinsurance market. I mean, this is just the global pools of capital. Obviously, Bermuda is not going to have the GDP, the resources flowing through its domestic banking system to bail out a crisis if one occurs. So that triple-legged stool, I think you're looking at for Japan to make it out of this. Maybe Japan, if it were by itself, they wouldn't be able to come up with the policy prescriptions to navigate this turmoil. But I think what we're going to see is a test, and when you have the U.S. plus Japan, and could be other private capital players, globally as well, who are aligned with that sovereigntist movement. I think that's enough to get this done. But I think, yeah, the coming days, months, weeks, you could see a volatility event. Um, January 20th, that might have been just the initial signal. You're seeing other signals go off. Same thing like the Indonesian market close. These things under the hood, they're related in the financial system. So you're
Right.
seeing a pull for liquidity. Um, that's a sign. Watch out. End of quarter. Like by the time we get into March, that's when these things can develop to a head. So we'll keep watching this closely. And the last one we want to touch on,
Final parting
talking about the
shot.
U.S. situation. Yeah, you're hearing Scott Bessent go out. He's talking about the U.S. The term he's using, I know he's, part of his job is to be extremely adept at, managing capital markets interactions, stewarding the public treasury. My opinion, he's doing that well. But another part is messenger, right? So you see him going out after Davos. The term he's using, what he's pitching the public is Bountiful 2026. And what he's describing here is a non-inflationary economic boom. When he says non-inflationary, um, he doesn't mean it in the Austrian sense. Like a lot of the audience might know this. Like when we say inflation, if you're actually using the true monetarist definition, what you mean is an expansion of money supply. What you look for that as an expansion of commercial bank lending and credit into the real economy. He's not saying non-inflationary in that sense. So I think what he's looking for is banks to be able to do that balance sheet expansion, create more money. But what he's saying is there's actual real economic growth in the U.S. And productivity taking hold, so that credit expansion is actually going into projects that are economic, like the opposite of malinvestment. So I think, yeah, that's what we're seeing. We talked about the signals. If you go back to Dow Theory, you see the industrials in the U.S. breaking out. You see the transportation sector joining it. Despite the volatility, since basically Davos, those trends remain intact. So all of this core policy that this administration has, really pinned its hat on for its first year and track record, talking about revitalizing Main Street, reindustrializing America, providing real economic growth in the U.S. economy. Those things are all happening, in my opinion. If you look at the market indicators, you look at the data, those things are taking place. It's a messy process, and there's a lot of blackpilling out there, but that gives you the ultimate backdrop that allows. You talked about Japan plus the U.S. Um, being enough, right, to get through the whatever comes out of this Japanese, life insurers, mini crisis that we're talking about potentially unfolding. The U.S. economy is your like secret weapon. Like that is what gets the job, allows us to get the job done, in my opinion. So keep watching that. 2026 will continue to shape up very interestingly. I'll just leave a little bit of a nugget here. Talked about the dollar sell-off, right? I've got some call them analysts on X, Twitter, who have been very spot on in terms of the big picture, like generational type moves and gold, silver, the dollar that we've seen play out over 2024, 2025, and going into 2026. I've seen some voices that I really respect recently start to call out, hey, this move in the dollar. We talk like very widely noted here to start the week. It broke below the post 2008 bullish channel that the dollar was in versus other currencies, mainly the euro, which makes up half of the index. One of those analysts called out that, hey, this break, just looking at all the technicals, prior consolidation levels, all of that takes time and actual talent to be able to make those calls. They mentioned watch for this breakdown in the dollar to be the false, or in the DXY index to be the false move, which means basically the first instinct of the market is to sell off the dollar into the developing news. False breakout would mean, all right, you break, but then it turns out, market got that one wrong. Sorry, bears, you didn't actually have the tug of rope. It's like Popeye eating the spinach, and just discovering that instant strength. Market pulls the other way, and the bulls take it the other direction. That would basically be the scenario that this analyst was calling for, and for that to happen, for the dollar to reverse like that, what you would need to see is a weakening of the euro, which is a different setup than fundamentally the reasons and mechanisms by which Scott Bessent and the large banks and the U.S. have been kind of coordinating the dollar to be weaker and also marking up gold. Um, a sell-off in the euro against the dollar, in my opinion, like a true breakdown, would be a different story than what we're seeing with, say, the dollar structural weakness over 2025 and going forward so far in 2026. That leads into the stories we've been talking about on prior episodes of the weekly roundup as the euro financial direction kind of narrative unfolds slowly. We've seen stories, after Liberation Day, April 2025, you saw kind of a renewed vigor in the headlines
Right.
from ECB officials like Christine Lagarde. Hey, we got to get the digital euro out. We got to launch this new savings and investment union. And in my opinion, you're seeing all the signs of kind of desperation, especially in their interviews at Davos that we started with last week. There's going to be a big monetary transition as well that the Eurocrats see coming. They've been planning for. But in my opinion, if this analyst I talk about is correct, like he's calling for the false move in the DXY, what that means is a breakdown in the euro, structural crisis. That's where the rest of 2026 could be very interesting. So, point being, this is probably going to be a big year in terms of monetary history. We hope you're here to enjoy it with us and buckle up. This plot is going to get interesting.
Yeah, and I think that's a good spot to leave it. I know we went long on this episode, so I appreciate everybody listening in. Hopefully, you're still here. If not, that we, as always, have clips and all of that, so definitely share those with your friends and family. And with that, we'll see you all next week.